Okay, we've had a bit of a bumpy ride in the stock market this week and the last month or so. So I wanted to take a step back, do a semi-scripted video, just looking at what's happened in the market, things you should know about. And also I want to take a little bit of a different perspective on what other channels have been talking about and what other people like to go into, because I don't think it's as simple as just giving you all the reasons why things could have happened without giving you a bit of context too. So let's just have a look at what's been happening at the moment. And actually it's quite interesting is that as I film this video today, on the 12th of March, that the market's having a bit of a pullback already. So one of the first questions is this crash already over? Now, the S&P 500 is down almost 4% for the past week and more than 10% for the last month, at least at the time of making this video. I'll put the latest ones up on screen now to have a look at. And then some of the other really popular indexes like the QQQ, which tracks the most popular technology stocks, is down 13% for the past month. And VWRP, which I'm going to use as my benchmark for global stocks, are down 8% for the month. So there's almost nowhere you can hide at the moment if you're an investor. What's been interesting this week is even the BBC sending out push notifications to your phone about how the stock market was down. This rarely is a daily thing that is covered in the mainstream news. So this has definitely had a big impact. And Monday was a big old red day in the market, with the markets taking around a 2.7% hit, yet many individual stocks, as I'm sure many of you will be aware, took a much bigger one. Things the likes of Tesla, for example, taking more than a 15% hit in a single day, leaving lots of people very angry and lots of people very disappointed. Now, I don't want to go into too much detail and too many explanations in depth onto why the stock market crashed and what's going on at the moment, because I think you can fall into a trap of explaining things very simply, which would assume that then you could predict the future in some way. Obviously, there's a lot going on at the moment. You've got the uncertainty of all the tariffs going on, which are going to create some kind of global trade war. You've got a tariff one day, then you haven't got it the next hour. You've got double tariffs, then you've got no tariffs, and you've got a huge amount of uncertainty in the market. And I think all of this definitely plays a big impact. Then that leads into a fear of some kind of recession in the US. And if there's a recession in the US, then we're all going to feel something in our investments as the biggest stock market in the world ultimately. And if these big companies start suffering, then it's all going to trickle down and we're all going to feel something. Now, you can go into loads of detail on all of these points and you can look at amazing charts and you can speak to very intelligent people and economists. But at the end of the day, nobody knows what's going to happen next. As much as they tell you and they convince you they know the future when they go on TV or have various YouTube channels, etc. That is not me. Anyway, what I wanted to do in this video is just go through a few different themes, work through them with you, and then I'll give you a bit of an idea of what I do and what I think other people potentially should look at if they want to get through a stock market crash, if we were even going into one. So first things first, on my phone here, the first theme that I've wrote down here is called perspective. Now, Monday was a terrible day for the stock market, but you may have seen that the S&P 500, for example, was down 2.7%. Now, that doesn't even come close to the top 50 worst days in the stock market. If I have a look here, I can show you the top 20 worst days, for example. And to even feature on the top 20 worst days, you'd be needing to look at around a 7% drop in the market. So we're nowhere there. So if you want some perspective on whether this is good or bad or what's happening, this doesn't even scratch the surface of really bad days, which could be possible and have happened in the future. Now, that's the markets overall, but I did note here that lots and lots of individual stocks for you investors have done extremely poorly. Lots which have run up to unbelievable valuations have now been brought back to earth. Tesla is the worst performing stock in the whole of the S&P 500. Gets all the negative press and has gone all the way down from around 480, I think it was, down to about 240 now or something. So that's a huge amount of wealth from people potentially lost. But this is a topic that I'm going to talk about a little bit later on when we talk about these things like losses and gains, because I think we can get a little bit carried away when we talk in these terms. Now, the first lesson that I wanted to talk about when it comes to perspective is that if you are going to invest in any individual stocks and not just buy the overall market in some kind of index fund, then you will have to put up with amazing volatility of these individual companies going up to the moon and potentially even going bankrupt. And that doesn't matter if you buy the world's highest quality companies, they were always going to go through some level of decline, whether that's just because the market goes down themselves or because, I don't know, other competitors enter into the market or those kind of things. And this is reminding me of some of the great stories there's a book I've got called 100 Baggers by an author, Chris Mayer. So he looks at all of these stocks which have basically 100x'd in price. So gone from $1, for example, to $100 and the equivalent over many decades most of the time. Now, one of the things he said, what's quite interesting here, was he's got different stories in the books of some of the most popular companies that you can buy and the ones that have been most profitable. Now, before Nvidia overtook them just a few months ago, the number one stock in the stock market of all time ever since IPO was Monster Energy, which many of you nerds will be aware of. Now, even great companies like that who performed really well have dipped many, many times, 50%, 60%, 70%, and even more. I mean, famously, you have companies like Amazon, which dipped more than 95%. That was back in the dot-com bubble. So if you want to invest in individual stocks, get used to this. This is just the price you're going to have to pay. The difficulty is knowing what's going to happen next, and nobody knows that. Many people will claim to know the future, but I run away very, very quickly from those individuals. But do be aware, if you want to get involved in the market like this, then you're going to have to put up with this. And it doesn't matter how good the business is. Businesses can fall their share price anyway from one day to the next, just can be anything. So please be aware of that if you are going to go into individual stock market investing. Now, this does also remind me of a great interview from Peter Lynch, who was one of the finest investors of all time. He ran a fund called the Magellan Fund. I think from around, it was the 70s to the 90s. It was like a 2-decade period, might have been a bit longer. Forgive me if I've got that a bit wrong. But he said that every time the market went down, his fund also went down. It doesn't matter how good his research was or how good his companies were. And over a long period of time, his fund did very well. But there were plenty of short periods where he would follow the market or be even worse than it. So you have to be ready for that. This is just part of what investing is. So, and this comes back to one of the themes that I did in another video that I spoke about why I think we need a stock market crash. You can go and watch that video and see what you think of it. I'll leave that one at the end. I don't want to spoil it too much, but I do think you need to be ready for that. Now, the next point that I wanted to make was this one. I've said that this idea when we talk about investing, about losing or gaining money, needs to stop. Now, let me just explain what I mean by this. The only time you lose or make money with an investment is when you actually sell it. So if you buy a stock for £100 or $100 and you see it go up to 200, and you may have had the best investment of all time in a week, unless you actually sell that stock for £200 or $200, you have not doubled your money. So you may see in your investing account 100% gain. You may think you're the best investor of all time and you've timed it amazingly. Look at you, you could have made yourself millions. But in reality, unless you actually sell, you've made or lost no money at all. Now, it is weird from a psychological perspective when we look at our investing accounts, and yes, I look at them just as much as probably you do as well, is that when we see green in our accounts, we get so excited, we feel wealthier, we think, wow, this is amazing, I'm glad we got started, etc. Yet, when we look at our account and it's in the red, we think the complete opposite. We think the world's going to end, we think we should sell out everything. And it's very weird how our unrealized gains and the amounts of money we have on paper can completely affect our behaviors, when in reality, we had no intention of selling. At least I don't, and many of you watching, as if you're a true long-term investor who's trying to invest and build wealth for decades, the number on paper now for your stocks or your mutual funds, your index funds, is totally irrelevant. It's only relevant, really, if you were intending to sell that investment, because then you are at the mercy of the rest of the market. You know, just think of this. During the dot-com bubble and the global financial crash, there would have been loads of accounts of people from over in the US, here in the UK, with millions of pounds of unrealized gains in it at the peak of the market. But unless they sold, which most of them didn't, because that's not how investing works, then they ended up a lot poorer because they ended up selling right at the bottom, and that comes down to human psychology. Now, a good story of this, and I think I've told this one before, and it does get wheeled out quite a lot. I think it was in Benjamin Graham's book, The Intelligent Investor. He gave the example of calling a physical person Mr. Market. He comes at you every single day with a price. Now, I think it helps if you imagine, if you own your own home, or even if you didn't, I think this story still applies. Imagine some guy just comes to your house every single day and he offers you a price for your house every single day. You get a new price every day. But it's very erratic. Some days he'll knock on your door and it's worth twice as much today than you thought it would be. So you feel pretty good that day. You talk to your other half. You're like, wow, we could move to a bigger house. Look how much it's worth. It's all great. And you feel good about yourself. You might even go and buy yourself, more chocolate, more sweets when you go and you do your weekly shop because you feel good about yourself. Then over the next few weeks and months, he comes at you with a worse price and it keeps getting steadily worse and worse. And then you start feeling really bad about yourself. You think, wow, this could get much worse. Maybe we should sell out now and move. And the funny thing is, you had no intention of moving in the first place. You had no intention of selling. Yet the act of someone coming along and offering you a price is starting to change the way you feel. And it's very, very weird how we wouldn't do this with our own house, yet with our investments, we're much more likely to change them or change our strategy based on what they're worth at any specific day in time, when actually it's totally, totally irrelevant, at least in my opinion. But I'd love to get your thoughts on that one. So anyway, I think sometimes you've got to step back and actually ask yourself why, as a long-term investor, why that number on the screen even matters. I would actually wager, and many people have said this before, that most of us would be far better off if we just invested regularly into our investing accounts and actually never looked at the market ever again. The act of looking at your account and just constantly looking at it and worrying about it on a day-to-day basis is only ever really going to be bad for us. I often go back and quote data in the past and say how there's been no 20-year period, for example, rolling 20-year period where investors could have lost money while investing. But likewise, there's been no periods like long-term periods where you haven't had a downturn in the market. Even if you've had the best 20 or 30 years, there are always going to be times of recession, stock market crashes, corrections, etc. So this is just part of stock market investing. And really, you just need to get used to it. And the way I would always think about it is just this is, the price that you have to pay if you want your money to grow. The market is priced accordingly for more growth because it is effectively a bit riskier to do with your money. The alternative, which you're very welcome to do, is go and use a low interest savings account or even a high interest, cash ISA account. But the returns you get there are going to be much lower. They might be guaranteed, but they're lower because there's virtually no risk in those investments. For those of us who want to build wealth, we're going to have to take on a bit more risk. And in order to enjoy those potential future returns, because nobody knows the future, we have to take on that risk. So you really just need to get used to it. And there's no better way of getting used to it, unfortunately, than experiencing these downturns. So you have to learn how you react from them and just try and learn a bit of lesson there about teaching yourself what you should do moving forward. Another theme I wanted to highlight was this, and I've mentioned it before, but the market is totally unpredictable. And it's amazing how many people will be able to go on TV and explain the last few weeks and the last few months with amazing analytical detail about why things are happening and different macroeconomic reasons and interest rates and levels of debt to GDP and the US's debt and all these different things, unemployment, etc. Yet, no matter what explanation they give and how detailed their analysis might be, they cannot predict the future. Yet, there are plenty of people out there who will claim to be able to predict the future with even a low level of certainty. Now, unfortunately, we're just going to have to accept that we live in a world where people will claim to know the future. And it was quite funny in another book, which is just above your head at the moment, called Thinking Fast and Slow by Daniel Kahneman. Now, this is a book really around psychology, and he does talk about investing a little bit in the book, but it's more just about psychology generally and the way our brains are wired. Now, he said, the future is fundamentally unpredictable, and yet our brains have evolved to make us crave a sense of certainty and control. We want the world to make sense. I think it's worth just taking a time to appreciate what he's said there. Effectively, we're looking at something which can't be predicted, yet we want reasons. We want to know if there's a rational reason, a logical reason why something's happened, so we can potentially predict it in the future. The market doesn't work this way. You've got people interested in short-term gains, long-term gains, traders, computer algorithms. Everyone's fighting for a bit of the action. Some people are looking to make money in the short term. Some people just want money in the long term. Some people can take on lots of risk. Other people can take on very little risk. No matter what people are doing in this market, they are all just making a bet at some point and taking on different levels of risk because nobody knows the future, no matter how many times people will claim to do that. And they'll claim to have some kind of amazing system to be able to buy the right stocks and buy the right investments. I'm afraid, guys, it just doesn't work like that. So here's my last couple of points for you, one of which will be what I'm doing and the way I think. But one of the trends and at least points I put here is control what you can control. None of us can control what other people do in the stock market on a day-to-day basis, what traders are going to do, what hedge funds are going to buy, etc. The only things we can control are our emotions, when we buy, when and if we sell, what you choose to buy, the accounts you use, and then to a certain extent is how you structure the rest of your own finances. If you can get everything in order and automate your investing, buy broadly diversified investments which protect you with diversification, make sure you invest regularly. These are the only things that you can control and that we can all control. we cannot control our returns and how much we're going to make in the future. There is no way to even know if we'll have a positive outcome during any 10-year, 20, 30, 40-year time horizon. But I do know that we need to do something, as I've spoken about many times on the channel, because if you don't do anything, then your money is going to lose value to inflation. Holding on to cash is going to be one of the worst things any of us could ever do in the long run. And unfortunately, as a nation, we're very, very good at saving money and putting money away for a rainy day, but we're terrible at taking the next step of actually investing that money and growing that money above the rate of inflation, a significant set, so you actually get a good amount of compound interest and really, over a long period of time, seeing that money grow. Now, many of you watching this as well, regardless of actually if you're an investor or not, every month you'll probably be putting money into a workplace pension or a private pension. You are investing in the stock market, whether you like it or not. So it's really good to know these things anyway. And we're all in this together effectively, but you can only control what you can control. So I would say just basically stop worrying about what you can't and I pay very little attention, honestly. It's useful to make videos like this, and you see lots of clickbait headlines for the stock market crash. Some of the channels will come out the woodwork that they haven't posted videos for a long time. They'll post a stock market crash video and they get lots of clicks and the headlines get loads of clicks. But should that affect how you invest next month? Personally, I don't think so. You're very welcome to have another opinion on that one. Do let me know again in the comments. And finally, here's what I do with my own money, and this hasn't changed, and how I will get through potentially a stock market crash, correction, recession, you name it. I very simply do the following things. We can break it down to 3 different sections. I invest regularly, so I invest every single month when I pay myself money. I will make sure that I invest in a broadly diversified set of investments. So that sounds very technical, but all that means is really just I buy low-cost ETFs and mutual funds, which invest in stocks from all over the world. So I own companies in all kinds of different areas. And most of that money, the vast majority of that money is in passive investments that will just track the global markets as we go on over the long term. And then the second thing I do is make sure that I use tax advantaged accounts. So I've covered this many, many times. So using things like my stocks and shares ISA and using my self-invested personal pension. Those are great because they're going to be tax-free as they grow. There's different rules and stuff that I've covered in other videos. But generally, I want to do that because, again, I want to keep my fees low. And that will enable me to hopefully have more money when I want to access some of it in the long distant future, which could be anytime. I've got no idea. And then finally, I just automate that and make things as simple as possible. And although I do look at the market for my job, and I do this for the full time, I keep things really, really simple. I think it's very tempting to think, wow, if you want to be a really good investor, you've got to be super, creative and make your portfolio really complicated, have loads of different assets and loads of different things going on. But I actually think with investing, it's the opposite. You want to keep things as simple as possible, because then when things do get complicated, when things get crazy out there in the market, you don't want to be managing these 15 different investments thinking, where do I put my money each month? I want to keep things as simple as possible. If you're investing a couple of £100 every month, I don't want to have 15 investments to choose where the money goes and how it's allocated. I couldn't think of a more difficult thing to try and figure out. But again, let me know in the comment section below. But that's how I'm going to get through the potential stock market crash or correction. Is it over now? Again, let me know in the comment section below. As I'm filming this, the stock seems to be on quite a nice recovery, but we've always got a few more days left at the end of the week. And there's many more days left over the next few decades when we're all going to be investing together. But anyway, I'll let you watch my stock market crash video. Let me know what you think about that one. I'll see you in the next video. Happy investing.